All right, all right. How is everybody doing out there? Waiting just a few minutes, getting some folks logged in. I see we've got 3 people tuning in, 4 people tuning, 5. There we go. All right. So I'm just going to talk just briefly a second while folks are logging in. Then I'm going to bring our guest to the stage. It is going to be a jam up, jam pack, absolutely great session tonight. Great session tonight. So if you are logging in right now, if you're just joining us, my name's Josh, along with my partner, Eric. We host Deal Maker Atlanta. We are with the On Purpose Investor, and we are so excited that you're here. So if you're watching a replay of this, or if you're here live tonight, this is going to be an absolute incredible session. So speaking of that, my partner tonight, Eric, wouldn't you know, I shouldn't say Eric, I should say his lovely and amazing wife, Tiffany, had a baby like today. I saw where that's Facebook official. So that is super exciting. Shout out to my friend Tiffany, who had the baby. I've learned never say that the husband had the baby. Eric's just supporting the one having the baby. I know that's important. So anyways, we're super excited. So Eric did want me to make sure that everybody knew how much he wanted to be here. He was particularly excited about today's guest and the topic, but I guess we'll let him off the hook with it being a baby. So, I guess that does kind of take precedence. So for those of you that are just joining here, this entire next hour to an hour and a half or however long is dedicated to 2 things. First off, we believe that people invest better when they invest with intention and when they invest in purpose. And what we do at Dealmaker Atlanta is not just talk about real estate investing. You can get that anywhere, and there's a lot of people that do that incredibly well. What we like to do is to take different strategies, different items, and sort of kind of break those down. Because again, if the goal is to help you invest with intention and in purpose, we want you to be able to dig deep and understand those things. So that's the reason why tonight I'm getting ready to bring to the stage someone absolutely incredible to talk to us. His name is Dan Deppen. Now, Dan is a seasoned real estate investor. He's the owner of Call the Underwriter, which is a firm that helps real estate investors create compliant, highly quality, like seller finance notes. And after a successful career in aerospace engineering, by the way, that is super cool in and of itself, and various other leadership roles, he transitioned into full-time real estate investing, and he has scaled a substantial note portfolio using outside capital, and he's become a trusted expert in creative financing. And I'm super excited that he's here because he's going to kind of focus on helping us build valuable notes, kind of talk to us about seller financing, and just kind of combining practical deal experience, but more importantly, that is regulatory compliant, because we all know that you can have the greatest thing in the world, but if it's not regulatory compliant, it doesn't really matter and it won't hold up. So I know it's virtual, but wherever you're at right now, with either your cup of coffee, you lift that glass in the air and please welcome to the stage, Dan. Welcome, Dan.
All right. Thank you. Glad to be here.
Dude, we are super excited to have you. I mean, when Eric told us that we were going to get you on, I was like, we're about to have an expert in this. This topic of seller financing comes up a lot, and I think it's going to come up a lot in the market that's on the way, because as interest rates are where they're at, a lot of us are looking for seller financed opportunities, or maybe we're looking to sell things with seller finance and to take the note and take the position of the bank. So I look forward to hearing everything that you've got coming.
Yeah, well, this should be good. So no, looking forward to sharing a lot of info you don't always find in other places.
Well, let's get right into it. I'm going to give you the floor, and then I'll remove myself off. And as my pastor would say, take us to church.
All right, sounds good. All right, well, thanks everyone. So yeah, and as people have questions, feel free to throw them in the chat and the various platforms. I think they will make it to me on this platform, or they'll also let me know, because I do have a presentation prepared, but I'm also happy to kind of freeform this and take this down, if there are any particular avenues that people want to go through. But, the main overarching topic for today is how to create good seller finance loans. So a little bit about me. So I started my real estate investing kind of an unusual way. I've been really active in buying notes, both performing and non-performing notes, for about the last 8 years or so. That was actually my first foray into real estate investing. I went straight into notes. And then at the end, towards the end of last year, I acquired Call the Underwriter. And so what Call the Underwriter does is we're an RMLO. And when investors are creating seller finance notes, we help with Dodd-Frank, Safe Act compliance, send out disclosures per TRID, and really help investors create quality, valuable notes that also, aren't going to run afoul of the regulators. As you mentioned, I'm kind of on my third career at this point. So I started my career as a mechanical engineer in the aerospace industry for about 10 years. Then went and did my MBA at the University of Colorado, and then as a product manager in the tech business for about a little over 10 years. So I worked for Oracle for 6 years, did some startup stuff. And then up until the early part of last year was a product manager at AWS doing a SaaS supply chain product. But in the midst of that, had always done a lot of investing as well. So now I focus on my note investing full time, and then also running Call the Underwriter. Oh, and that's my fiance, Allison. This is from our trip in Iceland last week. And unlike Eric, I don't have any newborns. My kids are older. So I've got one daughter who is about to start her senior year and another that's starting her sophomore year in college. So I'm very happy to be out of the newborn phase. It's definitely a lot easier when the kids have their own cars and they can drive to the store and get you stuff. Okay, so I'll kind of start by just saying, like, what is seller finance at a high level? Some of you are probably pros at this and have been doing it a long time, but some of you listening, this may be new, or seller finance may be something that, you've heard about, but weren't quite sure how it worked or what it was. So basically, when you do a seller finance transaction, so when you do a sale of a property, seller finance just means that the seller is going to hold the financing and basically function as the bank. So in this case, your buyer is the borrower, and then your seller is also the lender. And that seller / lender, in some cases is a mom and pop selling their property, but kind of more often than not, it's an investor, using seller finance as a tool. And tonight I'm going to primarily focus on owner-occupied loans. So when we talk about loan lending in general, right, there are a million flavors of loans. There's, credit cards, auto loans, mortgages, but then even then within mortgages, you have cases where it's owner-occupied. You may have investor loans, DSCR loans, hard money loans, those kinds of things. And so I try to be specific about the kind of loan I'm talking about, because one of the things that makes it challenging to understand the regulations and the rules of the road are, specific regulations apply to specific circumstances. And where a lot of confusion reigns is when someone says, hey, there's a rule that says you have to do this, but maybe that rule doesn't apply to the particular transaction that you're doing. But like I said, tonight I'm going to focus on owner-occupied loans. And so in owner-occupied loans, your buyer / borrower is also a consumer, right? And so there are consumer laws that are in place to protect that consumer, most of which were put into effect after the financial crisis. And I'm going to get into more details on those as we go through this. So why would somebody sell a property on owner finance? Like, why wouldn't you just sell to a cash buyer, or, sell to a buyer that's going to have other kinds of financing? So, one of the reasons people will sell their finance is basically you're creating a loan. You're now going to collect cash flows. And unlike, say, a rental property, you can now collect the cash flows without being on the hook for things like property management, repairs, things like that, right? You've got a borrower that owns the property. You're just functioning as a bank. And one of the nice things about that is if the borrower defaults on the loan, they stop making their payments. With that, you've got the right to foreclose if the borrower defaults. So you're in this kind of bank style position, which is pretty strong position to be in. And, some people don't even realize that, individuals are allowed to do this, but, you absolutely can. So, you would think it would be harder to function as a bank, but it's really not. And the other reason investors will like to sell on seller finance and create loans is that it has tremendous flexibility. So if you've had any prior experience with notes, they're really robust tools and you can get really creative and there's a lot of things you can do, right? So, number one, when you create the loan, you could choose just to hold on to it and collect the cash flow, right? Like much like you would with a rental property, but without some of the other baggage that might go along with it. But let's say you don't want to hold the loan. You don't want to collect cash flow. You want to get paid up front because you want to go do something else with that money. If you create a high quality loan, you can sell that loan anytime you want. There's a fairly robust secondary market for these loans, right? And so if you're creating a high quality loan, you can sell that loan actually to a institutional type buyer. And one of the nice things about that is if you meet that institutional buyer's buy box, they'll actually pay more than an individual investor would be, right? So you can cash out of this anytime you want, with the caveat that you've created a high quality loan. If you don't create a high quality loan, you may not be able to cash out of it at all, or if you do, it might be a tremendous haircut, and we'll get into that as well. Or with loans, you have the ability to sell partials. Like let's say you created a 30-year loan. I could choose to sell 5 years of payments to another investor. So I could collect some cash now and then hold on to the whole back end of the loan, right? So I sell those 5 years of payments. And then in 5 years, when that's done, I could sell another 2 years of payments. I could sell the whole loan, or I could just begin to receive the payments. Most of the people who are creating notes and involved in creative finance tend to kind of be wheeler dealers, right? So they're generally involved in other forms of investing, and a lot of times they want to move money around, or they have some big opportunities somewhere else. So if you own notes, you can always sell them. Like I said, you can sell a partial just to free up cash when you want. So not only are notes generating cash flows for you, they can kind of also be a source of ready funds when you want it. So what kind of models do investors have when they do seller finance? And it's really all over the map. And I talk to investors every single day who are creating these loans. And I always like to ask them about their business and, how they do things and how they find properties. And I'm not sure that there are two investors out there doing this in exactly the same way. But, some of kind of the high level main models that are out there are, some of these investors are fix and flippers. Instead of flipping and getting paid in cash, they flip and sell on owner finance and create a note. And then there's a whole other segment of investors who do nothing but go out and buy low dollar properties off the MLS and then just turn around and sell them on owner finance and turn them into a note. And, that can work because there are a lot of properties that banks don't like to lend on, kind of independent of the buyer. So I don't really get into it so much in this presentation, but some of the rules that came into place after the financial crisis put limits on fees that banks can charge to originate loans. And a lot of those fees are set up as a percentage of the loan balance. And, banks have fairly high overhead costs. So a lot of times if it's say like a sub 200,000, definitely like a sub $100,000 property, banks just kind of don't like to lend on those properties, right? And so if you've got a seller, they're trying to sell it, say it's a, 100K property, it's out in, Michigan, something like that. It can be really hard to find a buyer because what buyer buying a $100,000 house has $100,000 in cash to buy it? If they can't get a bank loan, that becomes very tough. So what the investor, what you as the investor can do is you can come in, buy the property for cash, and then wheel around and sell it on owner finance and create the note, right? Because when you're selling on owner finance, all things being equal, because you're providing a service to the borrower, right? You're providing financing that they can't get elsewhere, otherwise they would. It's fair, usually those sales go at a somewhat higher price, right? I mean, usually like, can be in the neighborhood of 10% higher. Sometimes people go a lot higher than that. I don't necessarily recommend getting crazy with overpricing, overpricing properties, because then you get into a problem where the borrower doesn't really have equity, and you don't want to do that. But it's kind of amazing to me that people just go buy properties off the MLS and then just turn around and sell them without making any improvements or doing anything to them. One increasingly popular strategy I'm seeing more is converting rental properties to notes. So there are a lot of landlords out there who are either retired, or they're kind of gearing up for retirement, or they're just sick of being a landlord, and they want the cash flow from their portfolio, but they don't want to be on the hook for property management, repairs, and all the things that go along with being a landlord. So what you can do is sell the property, turn it into a note. Now you've got cash flow. In many cases, you've got more cash flow than you would have from the rental, because now you're not on the hook for rental, for expenses and repairs and things like that. Now, granted, if it's a 30-year loan, the money's going to run out at some point. But if you're, getting into retirement, you may not care. And then there are actually some tax benefits to that, because if you're selling on owner finance, that's treated, and I'm not a tax guy or an attorney, so don't take this as legal advice, but I do know that, those are treated as installment sales. So versus selling like to a cash buyer or someone with bank financing, especially if you have an older note rental portfolio where you own the properties outright, you're not paying taxes on the whole thing. You might be paying taxes on the down payment and then the payments you receive going on. Now, you can't claim depreciation on a note, but usually that's far outweighed by the fact that you're not on the hook for all the property management expenses and other things. But that's another one. I see a lot of clients creating wraparound mortgages, either just wrap some properties that they own or as part of subject to deals. So not going to nerd out on those too much today, but basically that's when you sell a property and you leave the underlying financing in place. And so properties being bought subject to the original financing. And in that case, you really want to make sure you have a solid borrower, solid note, in case something happens with that underlying note, like it gets called in. Let's see, Chris had a question. My understanding is that selling a property with owner financing is recognized by appraisers as a premium feature that can increase the value up to 10%, correct? Yeah, that's absolutely correct. And in some cases, they go for quite a bit more than 10. But yeah, all things being equal, the property should sell for more if you do owner financing. Plus, from the borrower perspective, it makes sense for them, right? Because now they're getting access to a property where they couldn't otherwise get financing. And it's not necessarily that they're bad borrowers, but I'm going to get into this a little down the road in the presentation. But, the bank standards are pretty darn tight these days. So, a lot of times you have perfectly compliant borrowers, but maybe they're self-employed, which, banks kind of frown upon or something like that. You can get them into the seller finance. And even then, their payment on the mortgage is often going to be less than a comparable rental rate. So it kind of works out for everyone. Where I've created probably 5 or 6 seller finance notes over the course of my note investing career is as an exit from an REO. So when I've bought non-performing notes, right? So this is where you go out, you buy an existing note, the borrower's delinquent. And what I'll do is try to work with the borrower to get them paying again. But sometimes that doesn't work. If that doesn't work, I'll try to do a deed in lieu, cash for keys. If that doesn't work, I'll take it through the foreclosure process. And when I take it through the foreclosure process, now I've got this REO that I really didn't want because I wanted a paying note. And for me, when I get REOs, they're a big pain because they're never in my backyard. I live in Denver, and most of my notes are in, either the Southeast or the Midwest, a lot of Michigan, Indiana, Ohio stuff. So when I get an REO property, it's at a distance. It's a big pain for me. So, but it's always nice when I do end up with an REO, if I can sell it on owner financing. Now I've created a new loan. I'm getting the cash flow that I was looking for from the original loan. And, a lot of times when I do get REOs, I go out of my way to work with the borrowers to get the loan reperforming. So the kind of borrowers that just sort of ride the ship down, when that happens, they live kind of a rough lifestyle, right? So if I have to sell it to a local cash buyer who's probably an investor, fix and flipper person, they're not going to pay me nearly as much as the seller finance buyer. So for me, that's I always prefer to exit from an REO and seller finance if I can. And then I guess I kind of jumped the gun on this one, but yeah, there are a lot of properties that for various reasons are just not conducive to bank financing. And these are usually, lower dollar properties where it's going to cost the bank more to originate the loan than they would necessarily make in the fees. And then, there's a bajillion individual flavors of these. Like I said, I don't know that any two investors do these quite exactly the same way. That's why I'm always fascinated talking to these folks. And they're very creative and very dynamic. The other thing I've observed is when folks, do a few of these things and they get their model kind of dialed in their area, they tend to kind of go ham and then just start doing a lot of them until they run out of money to do them. So it's a fun topic. Okay, so this, I might be jumping the gun a little bit, but it's a little bit of an eye chart. But I just wanted to show you this up front. So as I go through the rest of the presentation, it will hopefully give us more context. So a key part of creating a seller finance loan is doing the RMLO and underwriting work to make sure you've got a compliant borrower and a solid loan, right? So the way that we do it at Call the Underwriter. So the investor, so what you should be doing as the investor, right? Say, okay, I got this property. I want to sell it on owner finance. I mean, the first thing you're going to do is sit down and kind of sketch out your deal terms, right? So you're going to look at, say, okay, what's this property worth? What can I sell it for? All right, I'm selling it for owner finance. So maybe I can get some price bump. How much of a down payment am I going to require? What kind of interest rate am I going to charge? What are the monthly payments going to look like? You're going to put together, what does my ideal loan look like? Then we're going to go out and list our property for sale, and we're going to find borrowers, and we're going to do, and I can maybe get into this later if we want to, but you're going to want to pre-screen those buyers before we put them through the full underwriting process. This is like a 5-10 minute conversation to find out if they have any red flags or things that might not work. And then once we've got our terms and we've got our borrowers, then you submit a term sheet to Call the Underwriter. And so there's a link on the Call the Underwriter website to submit a term sheet. And then that gives us your contact information, the borrower's contact information, the subject property info, the terms of your deal, any fees you want to charge to the borrower, copy of the purchase contract, sale contract if you already have it, all that good stuff. And then we start doing our thing on the underwriting process. So we'll request an application from your borrower, an authorization to pull credit, their income documentation. We'll collect all that information from the borrower. We'll turn the crank on our underwriting process, which I'm not going to detail here, but I'll get into. And then once we've gotten through there, if things look good, we'll send out the loan estimate to you and your borrower. That's document required by TRID. And then if there are any loan conditions, so sometimes a borrower can be compliant, but maybe there were some things we need to just clean up or address. So like one example of a loan condition would be, there might be some recent credit inquiries. So we would want the borrower to state whether they've opened any new lines of credit that may not have shown up on the credit report. Or maybe they've got a credit line that's in collections. And so you might ask them to either bring that account current or get a payment plan in place with the borrower, things like that. Or we might just come back and need additional clarification on their income or something on their application, things like that. And then once we send out the loan estimate, if everything looks good to the borrower and the lender, we send out the closing disclosure a couple of days later. That's another disclosure required by TRID. And then at that point, from an underwriting perspective, we're basically done. And then when we're all said and done, we'll send the lender the full underwriting package. So that has copies of the loan estimate and closing disclosures, all the original data we collected, the application, the credit report, the income documentation, the 1008, which is the official underwriting form, and then also a statement on Dodd-Frank compliance, assuming it is compliant. And then you're off to go close your loan. So I just wanted to give you that little bit of context before I get into some of the underwriting process and the regulatory stuff that drives how we do all of this. So there are, so every year, Fred and Tracy Rui do comb through a lot of data and put out a report on how many seller finance loans are created every year. And I think last year it was on the order of like a little over 90,000 nationwide, something like that. So there's actually, seller finance market is actually, even though this is kind of a niche thing, it's quite a large market. And I would argue that the vast majority of seller finance notes that are created are really bad loans created probably all wrong. Number one is a lot of people don't create their loans compliantly. So there were a lot of regulations passed after the financial crisis, and a lot of people flat out ignore those, either because they don't care or because they didn't know. A lot of these have bad borrowers. You'll find that the threshold for compliance is actually relatively low. So that's really like a low bar. But there are a lot of people who approve loans for borrowers that have issues. I've more than once, including, I think it was yesterday or the day before, told lenders after I've gone through their files, this dude is going to default. Like I have told them, I had one where I told a guy, I will bet you a large amount of money if you make this loan, this guy defaults. If it was me, I would not do it. But then the other one that's a little more insidious is lousy deal terms, right? So not getting enough of a down payment, setting an interest rate that's too low, things like that, that can devalue your loan and make your loan harder to sell or required to take some kind of serious haircut if you decide to sell it. And so when we're creating loans, like a lot of times people talk about compliance, I've got it in the tagline. But to me, what I have found, spending the last year going really deep on this is once you have the systems set up in place to do it, the compliance stuff is actually fairly easy to do. Like if you're working with an RMLO, they're going to create the required disclosures per TRID. They're going to tell you whether the borrower has the ability to repay. Like they're really fairly straightforward. And honestly, like as much as I'm not a fan of regulations in general, there's a lot of common sense in Dodd-Frank. And the bar that Dodd-Frank sets is fairly low. Like me personally, if I'm lending, I want to have a higher threshold, but that's me. But almost more important than the compliance is making a loan that is sellable, right? Even if you don't plan on selling the loan. So the reason why being able to sell the loan is so important is you think about it, like a lot of these loans are created with 30-year terms. I mean, a 30-year payment stream, 30 years is a long time. And, many investors I talk to don't care whether they can sell the loan or not. They're like, well, I don't plan on selling this. I'm just going to hold on to it. And I always find it kind of odd that, creative investors who are doing like all this creative stuff are involved in all this stuff. Like I said, they're kind of out there willing and dealing. They're willing to lock themselves into bed with a bad borrower for 30 years. So there's some of the reasons you might want to sell are a lot of times people do a lot of these, and at some point they just need to recapitalize, right? So a lot of times you want to sell a loan or sell a partial of a loan to free up funds to go do more deals. Or, maybe your plans change, right? You decide to go out and acquire some business, or you want to move into some other form of investing and you want to redeploy those funds, or you're already active in some other form of investing and you've got a really great opportunity somewhere else. And so you want to transfer these funds over. Or finally got my will put together recently. And if you think about, if you're creating these 30-year loans, maybe your heirs end up with these loans, right? And they may not know what to do with them, or they might not want to hold on to them. So maybe someone else wants to sell these at some point. Or if you're, getting very creative and you're doing wrap deals or subject twos, then they're, depending on the type of underlying lien there is, that loan could have a due on sale clause, and the bank may call that loan in which case you need to respond to that. And if you're in a fast foreclosure state like Texas, you might need to respond really fast. And, there are a lot of different ways to mitigate due on sale. But one of the strategies might be to pay off the loan and just unwind the entire deal. But if you've created a garbage loan that you can't sell, now you don't have that as an option, and you don't want to get jammed where you've got to pay off the underlying lien and, you can't do anything with this other loan. And then, so what makes a sellable note, or what do buyers look for when they look at notes? Well, one, they want it to be compliant, right? So one of the things that's interesting to me is in the note world, it's kind of backwards from most markets in one respect, right? Like most markets, your wholesale institutional buyers tend to pay a lower price. Your retail buyers tend to pay more. In mortgages, it's reversed. So if you have a really solid note that you can sell to someone like First National Acceptance, which is a bank in Michigan, or Melody Bank in Texas, they will actually pay more than most any individual investor. And because they buy a lot of loans, they have kind of set processes. They're also often easier to work with. But banks in particular, if they're buying your loan, really, really care about compliance, because if they buy a bunch of loans, even if they didn't originate them, that have issues, that can cause problems for them. And banks are obviously super, super risk averse. So they care about things like TRID and RESPA and Dodd-Frank, which Dodd-Frank basically means that if you're creating a loan for an owner occupant, it's their primary residence, and that you need to validate that they have the ability to repay that loan. Purpose behind that is they don't want people getting loans and then losing their primary residence because they can't pay them. And then there are a lot of state specific laws around usury. There might be caps on interest rates. Pennsylvania has some weird caps that fluctuate. Like I think right now they're capped at like 7 or 7.5%. It's kind of weird for seller finance. And then, other states may have their own little nuances. But then sellable also means getting your deal terms right. So selling it at the right price, getting a large enough down payment. Down payment is like one of the key terms that most buyers use. Like they want to know what the overall loan to value is on the property, and then the interest rate as well. So when buyers buy your loan, what they're going to do is they're going to look at all the aspects of the loan. They're going to assign some risk level to it. And then they're going to decide, well, one, whether it fits their buy box at all, whether they're going to make an offer. And then if it fits their buy box, they're going to determine what return they require based on the level of risk, right? So let's say they look at your loan and they, sorry, I'm calling into, they're going to look at the overall level of risk. They're going to assign a required return, and then they're going to discount that loan to get to that return. So like, let's say the buyer says they need an 11% return on this loan. Well, if you created your seller finance loan with a 5% interest rate, they're going to bid it at a massive haircut to you, right? Like that's going to be a huge discount that you don't want. So most of your seller finance loans are created with, interest rates. Usually they're around 9-10%. If you're in Texas, it might be more like 11-12. Other states like Pennsylvania that have limits, they might be a little bit lower, but having too low of an interest rate is like the quickest way to nerf the value of your loan. And then the documentation. So you want to get an attorney to put together your actual, mortgage or deed of trust docs, depending on the state you're in. If you're creating a wrap loan, you want to make sure you have all the proper disclosures in place. Some states like Texas have state-specific disclosures that you have to send. Having title insurance is good. And then you want to be able to show them that you have the loan estimate and closing disclosures. And then you also want to have a good borrower. So having that underwriting package is helpful because then the buyer of your loan can see the original loan application, the credit report, what the borrower's debt to income is. You'll be able to give them all of that data. And so if you do all of these things, you're going to have a really, really valuable loan. Okay, so we'll dive into the compliance aspect of this a little bit. So there's a lot of misconceptions around compliance, and one of them is that, if you're doing seller finance, then Dodd-Frank and TRID and all that stuff doesn't apply. And that's not true at all. You still have to follow the consumer rules, whether you're doing 1 or whether you're doing 100. You may have heard of the rule of 3, and that pertains to RMLO licensing. So if you're originating more than 3 loans in a year in a particular entity, they either want you to be a licensed RMLO or have a licensed RMLO involved. But even if you're doing 1 and you're doing it on your own, you still need to follow a lot of these rules. So seller finance is not a free-for-all. Maybe that was the case like back in the 1970s or something like that, but it's definitely not the case now. And then when I tell people this, sometimes they wheel around and the flip side of this misconception, they go, well, wait a minute. If I have to follow all these rules that the banks do, why doesn't the borrower just go to a bank? I'm no better than a bank if I have to follow the same rules. But that's not true either, because the bar to be compliant is fairly low, right? And while you do need to meet certain standards per Dodd-Frank, that doesn't mean that you need to have the same underwriting standards that banks do. You just need to be above that Dodd-Frank bar. And so this is kind of my mental model for how I think about where seller financing lives. So, on this vertical axis, like up at the top, this would be like tighter lending standards. At the bottom would be like looser lending standards. And so really what Dodd-Frank, et cetera, are doing, they're setting a minimum hurdle that you have to be over. So you need to be at least that. Now, if you're below the bar, you're not validating that the borrower has the ability to repay, or you've tried to validate it and you've confirmed that they don't have the ability to repay, or you're charging a higher interest rate than is allowed in that state, or running afoul of other rules, then you're basically in what I call like the predatory lending bucket, right? And the sort of classic predatory lending scheme would be go out and say, okay, I'm going to find borrowers with like a 30% down payment, and I don't care if they can afford to pay me or not, and I'm going to get this big down payment, and maybe I'm going to do it in a fast foreclosure state like Texas. And so I'm going to collect a big down payment. And if they don't pay me, I don't care. I'm just going to rinse them out in a foreclosure and go find someone else with another big down payment. All of these rules are pretty much designed specifically to prevent that kind of behavior. What's interesting, though, is that bank lending standards are way tighter than what Dodd-Frank and the other SAFE Act, the other rules actually require. In fact, they're probably, they're just kind of in another stratosphere, right? And what's interesting to me about this is, back before the financial crisis, banks were lending like below that line, right? You had like the no income, no jobs loans. They were just giving money to anyone. And part of the reason they were willing to do that was because they could package these loans and sell them to other people who either didn't care or weren't smart enough to know what was going on. I think in The Big Short, they called like the idiots from Dusseldorf or something like that. Well, everyone's wised up to that, right? So number one, even if it was allowed for them to do that these days, I don't think they would, because I don't think there would be a sucker on the other end to buy the loan. So really, like, the Dodd-Frank compliance standards are, pretty far down compared to what's happening in the real banking world. But in between here is this like huge gap in the middle, and it feels like that gap has been widening over time. And that's what I call the seller finance gap. And this is really where seller finance lives. So where you're going to go as a seller finance lender is somewhere hopefully north of the Dodd-Frank bar, but you're not necessarily going to underwrite to the standards of banks, right? Like if the seller financer is underwriting to the standards of banks, well, then that implies the borrower could get a bank loan, and they should just go do that if they can, because now they're going to get a lower purchase price on the property and probably better terms on the loan than they would generally get from seller financing. So that's my kind of mental model for where seller financing fits into the whole game. So getting into some of the specifics on the compliance piece. And again, I'm talking about owner occupied residential, right? So again, if you're making a loan to someone and they're an investor and they're using it as a rental property, or if it's a often like a second home, vacation home type of thing, then a lot of these rules don't necessarily apply. But the big one is Dodd-Frank. And so Dodd-Frank defines 8 elements of the ability to repay. And it's basically saying you as the lender, you have to validate that the borrower has the ability to make payments on this loan, so that if they don't, they're not losing their primary residence. It makes sense. Now, the other thing that's kind of interesting to me is there's the ability to repay, but like one of their elements is credit. Now, oftentimes borrowers can have bad credit or credit dings due to things that are not necessarily their fault, like medical bills, job loss, divorce are kind of like the 3 like famous things that will ding credit, but are highly recoverable. But sometimes I look at a lot of credit reports where it's pretty obvious, like, okay, this is a dude that doesn't like to pay his bills. So even though it says ability to repay, sometimes you're also looking at, is this somebody who's willing to repay their debts? And then TRID and RESPA. TRID is a terrible name. It's actually got nested acronyms. What is it? The TILA RESPA integrated disclosures. So this is the requirement to send out a loan estimate 7 business days before you close. The purpose behind this is so that your borrower has the time to go through and read all the fine print should they choose to do that. And then it also requires you send a closing disclosure 3 business days before you close, so they can read through that if they want. And then there's some specific rules around fees that can change, right? So if you send them a loan estimate and then you decide to add some big origination fees or some other ones, it also places limits on that, where like if fees are increasing, depending on what kind of fees they are and how much they increase, you may have to send out disclosures again and restart that 7 business day clock. And then there are also a lot of limits on what they call high risk features, right? So you don't want negative amortizing loans, like loans where the balance gets bigger over time. No balloon payments within 60 months. Balloon payments are a whole topic. So if you're talking about a residential owner occupied loan, I personally don't like balloon payments at all, right? Because if you look at your borrower, I would want to know specifically, if I include a balloon feature, like what's the reason why they need seller financing now, and that they're going to be able to pay the balloon or refinance later. You can put them in if they're within 60 months if they're after 60 months. It's kind of a typo on the slide. But even then, I don't really recommend it. I feel like you're kind of setting up the borrower to fail. If your goal with the balloon is to get liquid, then just create a really high quality note, and then you can sell that note and get liquid whenever you so choose. And then you also can't have things like prepayment penalties. And then there's a lot of minutia in those rules over, some of the details. In general, I suggest keeping your loan terms as simple as possible. Like you don't need to get creative in your finance, but you don't need to get overly creative in your loan terms, because it's going to confuse the borrower. It can confuse the loan servicer. You can confuse yourself if you're doing a lot of these. It's just a lot easier to definitely keep it simple. And then you always want to talk to your real estate attorney who's licensed in your state to understand if there are any specific state laws you need to be aware of. These are really tough to keep up with. I've thought about trying to create my own kind of database of these, but the challenge is there's a lot of states out there. These things change all the time. There's not really a good mechanism to get notified when they changed. And so, I would worry about that becoming quickly out of date. So I suggest to people to talk to your real estate attorney. And then if you're creating land contracts, which I generally don't recommend, except for some corner cases, understand the state specific rules on that. Some states like Texas have kind of I'm not sure if they've outright outlawed them or if they've just effectively outlawed them with some of the rules they created, or, Ohio has rules where in certain circumstances, they basically need to be treated like mortgages anyways. And then sometimes states have their own fee restrictions and things. So if you use an RMLO, then you've got all these requirements covered. Well, not all of them. Some of the state laws, you still need to talk to your attorney, but what we're set up to do is handle Dodd-Frank, TRID, RESPA, and FLAG if there are any high-risk features that we see. So again, the rules are complex. Complying with them is actually not if you use the right vendors. Okay, so another big question is, okay, what happens if you create a non-compliant loan, right? And what actually happens may not be exactly what you think. So I've done a lot of looking at cases where lenders got in trouble for originating loans incorrectly. And so so if you look at, the CFPB, they've actually been in the news a lot lately, the Consumer Financial Protection.
Well, where did he go? All right, friends. Well, here he comes back. This is just a temporary commercial break. There he goes, Dan. We're getting you added back.
Yeah, I still had internet the whole time, but
it's all good. I think we lost your slideshow. If you want to.
I have to re-upload them. Okay. Oh no, they're there.
Boom! I'll add it. Chris said it wasn't a storm.
Well, there are thunderstorm warnings where I am, but power stayed on, and I looked over at my modem, my internet stayed on. So I don't know what that was.
It's all right. Well, welcome back.
Thanks. All right. So we get back to where I was. Yeah. So when non-compliant loans are created, right? So I've done a lot of looking at where lenders have gotten in trouble for originating loans incorrectly. And if you look at like the list of people that the CFPB has gone after, which is funny because they list them all on their website and you get to the end of January and it just completely stops where they were told to like stand down. But CFPB enforcement doesn't really matter. It's never mattered to an individual anyways, because if you look at that list of who they're going after, it's like Citi Financial, Honda Motor Financial, like really mega big players, right? The people that tend to enforce these more at our level tend to be the state attorney generals, right? And if you look at where the cases where the state attorney generals have gone after lenders, they tend to be lenders who are doing objectively terrible things, like not like, oh, they were in this gray zone. I interpret it this way. They interpret that way. No, they're just like flat out breaking rules and doing it at scale. So like one big case several years ago was Harbor Portfolio. They had bought like 10,000 plus REOs from Fannie and Freddie after the financial crisis, put borrowers into them on land contracts. Basically got these like newbie borrowers, put them in these really wrecked REOs. In some cases, like the furnace didn't work or the roof leaked. And then, they weren't equipped to handle that. They didn't know what they were getting into. And then they would just do forfeitures on the land contracts and rinse and repeat. Colony Ridge, more recently, I think this was like the end of last year, they were collecting like these 30% down payments, doing it in Texas, not vetting the borrowers at all, and then just rinsing them out if they couldn't pay. So, assuming you're not doing objectively terrible things at scale, you're probably not going to have an attorney general knock on your door. Theoretically, they can, if you do one bad one. The reality is that's not super likely. But the more credible scenario, and the scenario to worry about, would be the one where you create the loan, the borrower defaults, you have to start foreclosure, but then the borrower wheels around and fights the foreclosure, right? So if you didn't send the disclosures per TRID, you never validated they had the ability to repay, you don't have a 1008 form, you don't have any of that stuff, well, then the borrower could just go to court and say, hey, I never had the ability to make payments on this loan. I don't make enough money. This person didn't follow all these rules. They took advantage of me. I'm a victim. And you could get into dicey territory there with enforceability of the loan. And a lot of times there, the enforceability may come down to what judge you have, what mood they're in that day, those types of things. However, and because like I said, I bought a lot of non-performing notes. I've done a lot of foreclosures, and borrowers will say all kinds of crazy things. The last thing you want to do is give them something that's valid, like you didn't follow Dodd-Frank. I had a borrower once who showed up in court, claimed that I restructured their loan to change their balance down to $5,000, and then they paid me, which none of that happened. And my attorney said, well, do you have any documentation for any of this? And the borrower said, I lost it in a kitchen fire. So that's, they'll throw anything they think can stick. So you don't want to give them like real ammo. But if they try that and you say, no, we validated the ability to repay. Here's all the income verification. Here's the loan estimates and closing disclosures we sent. This was their DTI and their loan application. You're going to be good to go. That's an easy challenge. I'm actually half surprised that there aren't any attorneys who just go around to borrowers in foreclosure and say, I'll get you off the hook if you have a seller finance loan and it was originated incorrectly. I feel like, not an attorney, but I feel like that'd be a fairly easy thing to do. But the other place that compliance really impacts you, and granted, hopefully you're creating good loans, right? You're not getting into too many foreclosure scenarios anyhow. But where it really affects you is the sellability, right? So not just the enforceability, but the note buyers really care, especially the banks like First National Acceptance. And even if it's an individual buyer, they want to know they can enforce the loan. They don't want to have issues that they have to fix later. I have bought loans myself that had bad documentation and in some cases illegal loan terms that I was able to buy for cheap and then convert them into a compliant mortgage. That's one of the advantages of being set up to do this. But most buyers are not going to want to deal with that, right? And then also the buyer needs to know that they can turn around and resell the loan at some point in the future as well. So, I would say from a compliance perspective, the biggest reason you should care is just your ability to get liquid on the loan should you ever decide to. And then, the secondary concern would be the enforceability of it. But if you're doing loans in the territory where the attorney general is going to come get you, well, then you're probably not listening to this anyways, because you don't care. Okay. Deal terms. All right. So this is another area that I think a lot of times people, when they're new to this, don't optimize the value of their loan. So we want to get the deal terms right. And so this can mean a lot of different things. So the price you sell the property for, down payment amount's a big one, the interest rate, the term of the loan, which is a little bit sneaky, and I'm going to elaborate on that in a second. You also decide what fees to charge to the borrower, right? So you're the bank. And so you can charge origination fees. You can charge all kinds of fees if you so choose within certain limits governed by those laws. But for example, like the underwriting fee that we charge, 90+% of our lenders add that as a charge to the borrower and they get reimbursed when they close. It's not as common, but you could say, hey, I want to have a 1% origination fee or something like that. A lot of people, depending on their structure, instead of creating one loan, they might create a first and a second. So I guess I could have put this on the earlier slide, but like what a lot of people will do is say the borrower is going to bring a 10% down payment. They'll collect the 10% down payment. They'll create an 80% first position loan and a 10% second position loan. And then depending on how they entered the deal and how they structured it, they've got their 10% down payment. They've got this high quality first position loan with 80% loan to value that maybe they can sell to a bank. And if they structure it well, a lot of people will do this where they end up with this 10% second position loan that they own free and clear. And so then they just hold on to that and they basically get freebies. That's another really good model that some people use. And then the sale price. So I guess we already talked about this a little bit, but yeah, as Chris mentioned, definitely can be higher than a cash price. And a lot of times borrowers are okay for that, right? Because most of your first time home buyers that are buying on seller finance that can't get bank financing, their point of comparison is rental rates, right? And so generally the way the math works out, their PITI on a seller finance loan is generally going to be less than rental rates, sometimes a lot less. And, you know, you as a lender, right, you're providing the service that the banks are unwilling to. So there's value in that. I do caution people not to go overboard on this. You know, there are folks out there who like buy properties for like $40,000 and resell them for like 80. And they do that because the buyers are extremely unsophisticated and they're comparing to rental rates, but maybe that $40,000 house is really messed up. You're getting into kind of like the Harbor portfolio model that they got in trouble for there. Because that really sets a big risk to the loan, right? If you're inflating the price too much and the borrower is going into the deal upside down, now they don't have the skin in the game that they're supposed to. So you're creating a higher risk loan, you know, overall. So definitely increase the price, but like do it within some kind of reason. Okay, so the three kind of big terms to wheel off, and I want to give you some specifics on these. So the down payment percentage. Now, you know, a lot of banks, you know, they want 20% down. You don't see that a lot in seller financing. I see it fairly rarely. Like a lot of times people will engineer two loans to structure that. If you can get a borrower to put 20% down, that's like the gold standard in seller finance. In general, if you get 15% down, you're like in the top tier of seller finance loans. The majority that I see are in the 10% range. And then I also see a lot that are like 5% and even less. I've seen ones at like 3%. I really don't recommend that. That's really risky. Like usually, you know, the less than 5% down payments are a case where, you know, the investor needs to get the deal done and they're limited on borrower options and they kind of take what they can get. But that's tough territory. Really want to be north of 10% and shoot for the 15 if you can. It's going to give you a much more valuable loan because if you're down even at 10%, you know, a lot of the banks, a lot of the buyers who pay the most won't be able to offer on the loan. And then interest rate is one that is really going to have the biggest impact on your pricing because like I mentioned a little bit ago, right? The buyer is going to discount the loan to some return based on their perceived risk level. And so that interest rate is going to have a big impact on that. There are other cases. I do know of cases where people have sold loans for above par, meaning above the balance. So I've seen investors create seller finance loans and sell them for up to like 102% of the unpaid value. But those are like AAA platinum loans. That's not a common thing. That's not something to expect. By and large, most buyers for seller finance loans, they're discounting it to a rate of at least 10%. And, if you've got the small down payment, sketchy borrower, other things, they may discount them up to 15%, right? So that interest rate has a big impact on the price that they're going to offer. And then the other thing that has maybe not quite as big an impact, but a pretty healthy impact and is a little more subtle, and I think sometimes it's not always appreciated, is the loan term, right? So don't necessarily just default to a 30-year term. Generally speaking, the shorter the loan term, the more valuable the loan. The reason for that is if you think about it, right? Let's say you create a loan, it's got an 8% interest rate on it. Your buyer is going to discount it to 12%. Well, if that's amortized over 10 years, they're going to need a much smaller discount to get to their 10% than if you were to amortize it over 360 months. Okay. So where you can try to shrink the loan term. Now it's tricky and it's not a freebie, right? Because as you shrink the loan term, the principal and interest payment shoots way up and your borrower may not want to do that. Or depending on what their debt to income is, they might not be able to do that from a compliance perspective. So you have to make sure it works, but just know that's a lever you can pull, and to try to keep the interest term as reasonably short as you can. Don't necessarily just, default to 360 months. So that's great. So a lot of this value, right? It depends on a borrower who has a good down payment, has plenty of income. I haven't really talked about it yet, but has good credit. So how do you attract like the really good borrower overall? And the number one step, and something that often gets overlooked, is the pre-screening. So on the Call the Underwriter website, I've got like a one-page pre-screening guide, and you really just want to have an early conversation with the borrower. And so you're doing things like you're understanding what's their income level. Can they document their income? How do they make their income? Do they have an idea what their credit score is? Have they had any bankruptcies or foreclosures? Things like that, right? And so if you go through that pre-screening guide, you'll identify 95% plus of the red flag issues early on. And that saves you from getting into the underwriting process and then finding out there's a problem late in the game. And then the other thing you can do too, that I've been thinking about more, right? So if you do the math on, let's say your loan with a 20% down payment and a borrower with a 700 plus credit score, let's say the bank's only going to discount that down to 9%. But your loan with the 10% down payment and the sketchy credit score, maybe they're going to discount that like to 13%. That's a big difference, right? So it behooves us to get a better borrower, because if you look at, let's say we're going to sell the loan, the amount we get when we sell the property, get the down payment and sell the loan. Well, if we can sell the loan discounted to say 8 or 9% versus discounting to 13 plus, we're coming away with a lot more money, right? So that actually gives us room to offer carrots to the better buyers, right? So you can, it's fair game to kind of have multi-tiered pricing, right? We say, okay, the price of the property is X. These are my seller finance terms. But if you can bring a down payment of this and your credit score is above that, we'll actually reduce the price a fair amount. And so you can do that to try to induce a better borrower, and you'll still make out much better on the back end, because you're going to have a way more valuable loan when you do that. And you really want to take your time with this. I mean, I know time is money, and sharp investors don't pussyfoot around when they're moving properties, but you just want to make sure you don't just grab the first warm body that comes in. Like, hopefully if you're marketing your property okay, you'll have multiple potential borrowers that you can talk to, and you can take your time and you want to find the right one, because you don't want to spend a couple weeks getting them under contract and going through underwriting and doing this and doing that, and then finding out at the end there's a problem and having to start all over again. It's a bad spot to be in. So to kind of summarize, right, from the investor perspective, I went through a lot of minutia there, but really you can keep this pretty simple, right? So From a compliance perspective, you just use an RMLO, much like for compliance on the servicing, you just use a loan servicer. Get your loan terms right, get your deal terms right, like really think through those. Use an attorney, use close through a title company, have really super clean documentation. You know, if you're getting a little bit fancy and you're doing wraps or subject twos, make sure you have all the appropriate disclosures in place, and then take your time and find the right borrower. And if you do all this, you're going to have a really solid loan that you can either choose to hold and it's just going to cash flow, you know, or should you decide to sell it, you know, either right away or in the future, you'll have a really valuable loan. So that's what I had for you guys tonight. Appreciate everybody joining, but, you know, definitely hang around for any questions that roll in. Oh, I can't hear you, Josh. You're muted, I think.
That wouldn't matter. Look at me. I need to upgrade my my tech mentality here. I just posted on there. Is there anybody watching that has any questions right now for Dan? I can get those over here. We can get those asked. We'll give it just a split second here to see if anybody has any questions. My big takeaway is that seller financing is really, if you do it right, is quite a bigger process than I realized.
Yeah, I mean, it's a bigger process maybe for the vendors. Like for the investors, it's not necessarily adding, you know, too much, but yeah, there's a lot of laws to comply with, and it took me a good 4 or 5 months of nerding out on that stuff to really understand them, because some of the laws were created decades ago, some are new, there's state stuff, some of them are written very vaguely. And in some cases, I had conversations with different attorneys that would give me different answers to the same question. So where I really got locked into the details of how they worked was I was able to have a couple-hour conversation with a gentleman here and who actually helped create a lot of the state-specific rules here in Colorado. And he explained the nitty-gritty of like how it works and the intent and some stuff that's not necessarily spelled out, because these rules are like buried in different places and different laws, so they beg for a lot of confusion. So Adam asked, I might have missed it, but did you say we're required to underwrite borrowers even if we're doing a rent to own type of deal? No, I didn't actually address lease options, but that's a good question. So with a lease option, you don't necessarily have to vet the borrower up front. However, when you get down the road and they're ready to exercise that option, you do have to vet them before you create that loan. So it's a good idea if you're doing a lease option to, you may just run them through the whole process up front. Now, if they're not going to exercise that for a year or two later, you probably want to come back and do a delta. And we can do that for people too. Like I told them, like, listen, if you're doing a lease option, you can pay us, we'll do it now, and then we'll do a delta when you get down the road and they're ready to exercise it, and won't charge you more for that. But it's also not a bad idea too to have some terms in there that say, okay, what happens, like that kind of spells out, these are the requirements that the borrower has to meet to exercise the option. And here's what happens if they want to exercise the lease option and they don't meet those, right? So yeah, the devil's in the details there, but to actually initiate the deal, no, you don't necessarily have to do that.
That's a good point. That's a good point. What do you think is the future as far as regulatory, you know, the regulatory market that's coming up on this? I mean, do you see this as being something that's going to get more regulated as it relates to compliance, less regulated?
Man, it's
hard to tell, like everything
it's really
else.
Yeah, it's really hard to say, right? I mean, I would say, you know, I would guess that the, you know, new regulations that might really impact investors will probably come at the state level, if they come from anywhere. You know, in the more recent years, you know, I don't know that there are any real systemic issues in the market right now, right? Like the stuff that like Dodd-Frank was designed to prevent has kind of subsided because banks are, originating much tighter than that. Anyways, we've definitely been seeing an increase in seller finance activity. If banks retreat even more and this becomes like even more mainstream, you may see more of that. But honestly, like it's a thing where most of the existing rules are not followed in seller finance today. So if you see anything, maybe it's a little bit more enforcement of some of the existing rules. Yeah, but it's hard to say. I don't know if I see a forcing function for anything too radical. If I had a wish list, it would be to have more of this happen just at the national level. Because like all the licensing is state by state, and then all the different states have their own like unique rules, and it's really a nightmare to try to keep up with. Like if we had like one set of rules to play by, it would simplify my life a little bit.
I bet it would. It would. Well, guys, I think we're going to go ahead and finish this on up. Dan, thank you for being here. I know like you've got a busy schedule. For you to spend over an hour with us, that was pretty cool. So I really appreciate it.
And a lot of them are CFDs that were created 10 plus years ago. And a lot of these CFDs, like the companies that created them, like Harbor Portfolio that got in trouble was a big one. There was like Watermark, Vision Property Management. There were these companies that went around and bought all these REOs from Fannie and Freddie after the financial crisis and sold them to borrowers on CFDs. Well, these companies had like really crappy processes. And like in some cases, they were using one size fits all docs that didn't work for certain states. Like North Carolina required tweaks and they weren't doing that. And, part of the reason they got in trouble in Pennsylvania was Pennsylvania had limits on interest rates that they were exceeding. Like at one point, their interest rate limit was like 6%. They were creating loans at 10%. And I have some of these loans that have issues. Like I had one that had these like highly illegal late fees in them, where the borrower had like a $30,000 principal balance and like $30,000 in late fees, which I'm like, I'm not even trying to collect these because I know that's wrong. So actually what I've done in my own portfolio, I'm doing this with two of them right now, is so one of the things you can do is you can go out and buy these CFDs with doc issues that nobody wants to touch. And then as long as the borrower is willing, takes two to tango, you can convert them to a mortgage or a deed in trust based on the state. And now you've got a clean piece of paper that's more valuable should you decide to turn around and resell it. So so I can definitely help with that process. I've actually been doing them for my own portfolio more than anything else. That's definitely, and it's a good way to, and I've done that a few cases specifically to clean up, paperwork and title issues and things like that. So it's a good strategy. Not enough people do it, I feel like.
Well, all right. Well, thanks, Dan, for clarifying that up for us. Thank you for being here. And this was absolutely fantastic. So we hope we can get you back. Maybe we'll get some follow-up questions. We'll probably break this down a little bit at our next in-person meetup, and we might have to get you back on.
Yeah, sounds great. Anytime.
Yep. And just to answer Susan, yes, we will have a recorded session. We'll try to get that posted for you on our YouTube and Facebook pretty quickly. And Dan, all your fans say thank you for being here. You've got fans.
Yeah.
So I know Adam's super cool guy, great investor in our area. So, all right. Well, thanks everybody for being here. What a great night. And I look forward to talking with everyone later.